Beginners are taught the wrong investment order, and that one mistake changes everything. Stay until the end where I answer the 3 most common questions about this. The wrong start. Most beginners open a brokerage account before they ever open a book on the skill that funds it. The investment order matters more than the investments themselves, and almost nobody teaches it. The self-asset. You are the highest returning asset you will ever own. Before stocks, before real estate, before gold, the person holding the investment strategy determines whether any of it ever actually works. The knowledge gap. Every dollar invested in the right knowledge at the right time has historically returned more than any market instrument. The problem is, most beginners never learn this until after years of chasing the wrong returns. The health tax. Poor health is the most expensive investment mistake most Americans make. Medical costs, lost productivity, and diminished capacity drain more wealth over a lifetime than any market correction ever will. The income floor. No investment strategy survives a broken income. Before you invest in anything external, real estate, stocks, gold, you must first invest in the income that funds everything else you ever want to own. The mental edge. The investors who consistently outperform in any environment do not have better market data. They have better mental models, clearer thinking, and stronger discipline, all built through deliberate self-investment over time. The skill premium. A beginner with one high-income skill and no investments will financially outperform a beginner with investments and no skill within 3 years. The skill creates the capital, the investments grow it. This sequence is not optional. The patience trap. Most beginners lose money in their first investment not because the market failed them, but because they had no knowledge, no plan, and no discipline. All 3 are self-investments that must come before the money ever moves. The foundation rule. A house built on sand looks exactly like a house on rock until the weather arrives. Your investment portfolio is only as strong as the self-discipline, financial knowledge, and income stability underneath it. The order matters. Invest in yourself first, build your income second, allocate your earnings third, automate it fourth. Skip any one step in the entire system produces far less than it should. Most beginners start at step 3 and never understand why. Question 1. Which high-income skills should a beginner invest in first to build real earning power? The copywriting yield. Learning to write words that make people take action is one of the highest returning skill investments a beginner can make. The startup cost is near zero, the income ceiling is uncapped, and the market demand has never been stronger. The sales return. Every business in America needs people who can close a deal. A beginner who invests 90 days in learning sales can command income levels that take traditional career paths years to reach, and the skill transfers to every industry. The digital marketing edge. Businesses are spending more on digital marketing than at any point in history, and the people who understand how to run ads, build funnels, and drive measurable conversions are being paid accordingly. The data dividend. Data literacy is the skill the next decade will be built on. A beginner who learns to analyze and clearly communicate what numbers mean becomes one of the most valuable and difficult to replace people in any organization they enter. The content edge. Content creation, video, writing, podcasting, is no longer just for influencers. It is a legitimate high-income skill that builds audience, authority, and multiple income streams simultaneously for anyone willing to invest the time to build it properly. The AI advantage. AI tools are not replacing skilled people. They are multiplying the productive output of people who know how to use them. A beginner who invests in AI literacy right now is getting ahead of a skill gap that will only grow wider every year. The no-code return. Building apps, automations, and digital tools without traditional code has created an entirely new freelance and consulting income tier. The investment is 3 to 6 months of focused learning. The return is a skill the market consistently underpays for. The finance skill. Financial literacy is itself a high-income skill. The beginner who understands budgeting, tax strategy, investing fundamentals, and debt management will make better decisions with every dollar they earn or invest for the rest of their financial life. The communication premium. The ability to communicate clearly in writing, in presentations, in negotiations is the most universally applicable high-income skill a beginner can build. It multiplies the financial value of every other skill they develop alongside it. The consistency edge. The highest returning skill investment is not the most impressive one. It is the one you commit to for 90 days, build to an income generating level, and stack on top of the next. Consistency in skill building is itself the skill that compounds everything else. Question 2. Once I have income, what is the best way to allocate it across a house, gold, stocks, and savings? The allocation rule. Before you allocate earnings to any investment, your emergency fund must be fully funded. 3 to 6 months of expenses in a high-yield account is not optional. It is the financial floor every allocation decision above it depends on. The index foundation. For most beginners, a low-cost, broad market index fund is the most reliable first investment. No stock picking required, minimal fees, historically 7 to 10% annually over long periods. This is where allocated earnings go first. The house question. Real estate is not automatically a good investment for beginners. It is a good investment when you have stable income, a 20% down payment, and a minimum 7-year hold horizon. Buy for the right reasons at the right time, not because everyone else did. The gold position. Gold is not a growth investment for beginners. It is purchasing power insurance against currency debasement and market instability. A small allocation, typically 5 to 10%, held as a hedge, not a primary wealth builder, is the correct beginner position. The stock strategy. Individual stock picking is not a beginner's game. The data consistently shows most professional fund managers underperform a simple index fund over 10 years. Start broad, stay consistent, and narrow your focus only after you genuinely understand what you own. The budget upgrade. The classic 50-30-20 framework. 50% needs, 30% wants, 20% savings is a starting point. The beginner who adjusts these ratios as income grows and knowledge deepens will outperform the one who keeps the same ratios fixed for life. The tax advantage. Every beginner has access to tax-advantaged accounts, 401k, IRA, Roth IRA, that most never fully use. The tax savings alone on a maxed Roth IRA over 30 years can be worth hundreds of thousands of dollars most beginners simply leave permanently behind. The diversification truth. Diversification does not mean owning many things. It means owning things that do not all fail for the same reason at the same time. A beginner who understands this builds a more resilient portfolio than most Americans holding 20 funds that move together. The debt first rule. For most beginners, the highest return investment available is eliminating high interest debt. Paying off a 24% APR credit card produces a guaranteed 24% return on every dollar applied, better than any market instrument accessible at the beginner level. The reinvest trigger. The most powerful allocation decision is committing in advance to reinvest every income increase before lifestyle inflation consumes it. Every raise, every bonus, every side income gain. This single trigger separates wealth builders from people who stay at the same financial level forever. Question 3. How do I stay consistent, automate my money, and make it work for me without constant effort? The automation rule. The most effective financial habit a beginner can build is automating every investment decision before willpower is ever required. Automate savings, automate investments, automate debt payments. Let the system run so your discipline is never the limiting factor. The pay yourself first. Before any bill is paid, before any spending happens, your investment contribution moves automatically, not what is left over after everything else. First, this single behavioral shift has created more long-term wealth than any investment strategy ever discovered. The dollar cost average. Investing a fixed dollar amount consistently regardless of market conditions, every month without exception, removes emotion from the equation entirely. You automatically buy more shares when prices are low and fewer when prices are high. Consistency always beats timing. The compound effect. A beginner who invests $200 per month at 8% annual return from age 22 to 65 ends with over $1 million. The math is not complicated. The discipline to start early and never stop is the entire investment strategy most Americans need. The lifestyle lock. Every income increase is the most financially dangerous moment a beginner faces. Lifestyle inflation. Upgrading spending to match every new earning level is the single biggest destroyer of long-term wealth. Lock your lifestyle, invest the difference. That is the game. The review habit. Automating investments does not mean ignoring them. A quarterly review, checking allocations, rebalancing if needed, tracking net worth, keeps the system performing correctly without turning investment management into a daily emotional occupation. The emergency buffer. Automation only works when a financial buffer protects it from disruption. An underfunded emergency fund means the first unexpected expense breaks the entire automated investment system. The buffer is not separate from the plan. It is what keeps the plan intact. The long game. Beginners who check their investment portfolio daily make worse financial decisions than those who check monthly. The most valuable thing automation does is remove the investor from the process, because the investor's own emotions are almost always the most expensive part of the equation. The identity investment. Every financial behavior you automate is a vote for the person you are becoming. Consistent investing is not just a financial strategy. It is the identity of someone who builds wealth regardless of circumstances. And that identity is itself the most durable investment you will ever make. You are the investment. Every strategy in this video depends on one variable, the person executing it. No allocation model, no automation system, and no investment vehicle produces returns from a person who never invested in themselves first. The market rewards those who showed up for themselves. Start there. Everything else is compound interest on the person you already built. If you found this helpful, consider subscribing to stay updated with our latest videos.